Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. In the equity markets, the S&P 500 ended the week off 0.25% after the latest employment figures, and Nasdaq was down 1.5%. But in contrast, European indices put in a more positive performance, while the FTSE finished roughly where it started the week. The FTSE 250, though, had another good week, up 1.25%. That's the mid-cap index. That may or may not have anything to do with Chancellor Jeremy Hunt's latest budget, announced earlier this week, which headlined with a 2% reduction in national insurance, but without many other surprises, and therefore produced not much in the way of market reaction. On both sides of the Atlantic, government bonds traded up as yields declined, long-dated issues to the fore. Gold was a notable strong performer again, edging up close to $2,200 an ounce at one stage, influenced perhaps by renewed hopes of early interest rate cuts this year. Turning to investment trusts, the investment trust index was up 1% on the week, with the average discount narrowing to around 15% and a bit as of yesterday morning. Gainers comfortably outnumbered losers. 11 investment trusts reported their annual results for the year to the end of December, and another 2 reported interims. The figures revealed a mixed picture, with a number of specialist trusts, including BlackRock World Mining, Premier Miton Global Renewables, and Bellevue Healthcare, all reporting negative NAV total returns for the year, a 15% decline in the case of Bellevue Healthcare. There were, however, positive returns for most of the others, including Alliance Trust, Foreign and Colonial, Mobius Investment Trust, Tetragon Financial, Apex Global Alpha, Greencoat Renewables, and RIT Capital, though not all of them outperformed their benchmarks. Standout performer was the 21% net asset value total return for the year from the Alliance Trust, which was some 6% ahead of its benchmark. I will be talking to Craig Baker, the chairman of the investment committee at Alliance, later in the podcast, and discussing that result and other items from the week's news, also with James Carthew, director of QuotedData, the investment trust research firm. Most disappointing result were probably those of RIT Capital, which reported a small positive NAV total return, but lagged its benchmark by fully 15% over the calendar year, and those shares remain out of favour. Among other items of news this week, the shares of Asian Energy Impact Trust, ticker AEIT, were relisted after suspension, but closed well below the most recent reported NAV at around 20 cents, valuing the company at just $35 million, a far cry from its value when it was launched in December 2021, before it ran into problems with its big Indian solar project. Hipgnosis Song's fund, ticker Song, was again in the news, never seems to be out of the news, as it reported the results of a new valuation prepared by a new independent valuer, which came in at 92 pence, at least that was the centre of the range of valuations the valuers came up with, and that was a 33% reduction on the last reported NAV, but still well above the current share price. The board of Hipgnosis Songs also confirmed that their dividends will remain suspended until they have completed their strategic review and resolved the issues around valuation and indeed management that have beset this particular trust for so long. On the other hand, slightly better news for Digital 9 Infrastructure, ticker DGI9, whose shares did move higher after it said that the sale of its largest and most valuable asset, Verne Global, should be completed by the end of the month. This follows consent to the transaction by its lenders and also getting a nod from regulators in both Finland and Iceland, where it operates. The shares there were the biggest gainers on the week. Elsewhere, we heard more announcements concerning the consolidation of the sector, which is ongoing. GCP Asset-Backed Income, ticker GABI, G-A-B-I, said it's completed its shareholder consultation and has received a broad range of views on how it should move forward. It plans to publish the outcome of that strategic review in the coming week. We had a circular from Triple Point Energy Transition, ticker TENT, T-E-N-T, giving more details about its proposed managed wind down. While we also heard from Smithson, ticker SSON, where the board has very promptly decided to reverse its previous decision not to hold a continuation vote at its upcoming AGM. That followed protests from a number of shareholders who said that that vote should go ahead since it had been triggered by its discount being wider than the threshold level set out in the continuation vote proposals. And we also heard updates on property mergers from Custodian Property Income REIT, ticker CREI, which added a brief update about its bid for Abrdn Property Income, ticker API, where it's in competition for the hand, if you like, of that trust with Urban Logistics, ticker SHED. And we also heard that UK Commercial Property, ticker UKCM, saying that the takeover panel has given another 2-week extension to Tritax Big Box to declare whether or not it intends to make a firm offer for the company. Finally, in terms of news announcements, if you want to see every single announcement that was made this week, then as normal, you should go to the Moneymakers website, where we do list every single announcement of any note that has been made by an investment trust during the week. But I would just mention the fact that 88% of shareholders in Abrdn China, ticker ACIC, opted for a cash exit rather than wanting to see their holding rolled over into Fidelity China Special Situations. But the terms of the merger limit the cash alternative to just 33%, so not every shareholder there will get what they want. The new shares have been issued by Fidelity China Special Situations, should begin trading this week. Finally, I can mention that our in-depth trust profile this week features CC Japan Income and Growth, ticker CCJI. While looking ahead, we will also be taking one of our in-depth looks at a number of other trusts, including Majedi Investments, ticker MAJE, which we discussed on the podcast not so long ago, Brown Advisory US Smaller Companies, ticker BASC, and finally, but not least, Rights and Issues, ticker RII, where the long-serving manager, Simon Knott, stood down some 18 months ago, and the management contract has moved to Jupiter. I had the chance this week to speak to Craig Baker, who is the Global Chief Investment Officer at Willis Towers Watson, best known as a firm of pension fund managers and advisors, but for this purpose, more relevantly, is the chair of the investment committee at the Alliance Trust, and has been responsible for their investment strategy since they were given the mandate to manage the trust back in April 2017. Craig, I think it's fair to say you have a distinctive approach to managing in the investment trust sector. Perhaps you just quickly remind us exactly of what your approach is and how that compares to your peer group in the global equities sector.
So Alliance Trust, as of April 2017, as you said, moved to this multi-manager structure whereby we're the overall manager of the trust at Willis Towers Watson, but we then employ a number of who we think are the world's best stock pickers to run their very best idea 20 stock portfolios, go anywhere globally for us. And then we blend those managers in such a way that leads to a portfolio that's driven almost entirely by stock selection. So we ensure that we take out any big style biases or big geographical biases relative to the benchmark or industry bets. And it's really stock selection that drives everything. So it's relatively rare to have a multi-manager approach in investment trust space. But what really stands out, even relative to other multi-manager approaches, is this 20 stock best ideas approach. And the problem of a lot of multi-manager approaches is that they end up with over-diversification. And so the ability to outperform significantly reduces quite substantially, and they've got that double layer of fees, so can be expensive. Now, we've managed to address both of those by having this highly concentrated portfolios run by these stock pickers, just their best ideas. And we've also managed to get the cost down significantly because of our reach as a global organization advising on a few $1 trillion of assets.
Essentially, this is an approach which you pursue in the institutional investment market, but by having the chance to manage the Alliance Trust, you're bringing that approach into the realm of the private investor, And Alliance Trust is well known for many years for having a focus on the private, or as we call, retail investor. That's been its tradition for many years. But this is a new approach, and one that is not replicated in exactly the same way anyway, as you say, in the rest of the investment trust universe. So that's good, that's distinctive, and you've just published your annual results. One has to say that this latest 12 months have been a good set of figures for you. Perhaps you could just quickly summarise how well you've done and what you make of them.
Yeah, that's right. So it's been a good year, as you say. We had a net asset value return of 21.6% for the calendar year of 2023, which was 6.3% ahead of the benchmark, which is the MSCI All Country World Index. The total share price return was 20.2%. So 4.9% ahead of the benchmark because, as you know, that discounts in the investment trust sector have increased over that calendar year of 2023. Actually, our discount remained very stable relative to the rest of the market, which is also pleasing. But yes, good results for the calendar year of 2023. What was particularly pleasing was that really came from stock selection, exactly as we would have hoped. So very little added value from big style bets or geography bets or industry sector bets. It really was stock selection that drove everything, which was pleasing. And the other good thing is that now brings the 3-year and 5-year numbers and longer term looking attractive as well. And it's been particularly strong relative to the peer group. It's just generally struggled relative to the market cap indices over the course of both 2023 and a longer period. So looking very strong there over 1 year, 5.3% ahead of the investment trust peer group, 9.3% ahead of the wider peer group of global equity funds that include all the open-ended funds as well. And over 3 years, 7.4% per annum ahead of the investment trust peer group and 4.3% per annum ahead of the wider peer group. So that's been particularly pleasing following that strong year in 2023.
So those are impressive numbers, and you're, of course, perfectly entitled to point them out, as you've done, and that's very good news for your shareholders. I guess I have to say that last year has been helpful, as you say, in bringing up your longer-term numbers since you took on this strategy. You do have a target of outperforming, I think, the world index by 2% per annum, and you haven't quite made that yet, I don't think. So what would you have to say about that, and how quickly do you think you can actually get to that objective which you have?
Yeah, so over the last 3 years, we have actually outperformed by 2% per annum. But as you say, over the full 6 3/4 years to December 2023, from the time we've been running it, we haven't quite made that 2% per annum outperformance. What we always said was that over the very long term, that's the kind of target that we think is achievable. And certainly where we've been doing this in institutional space for a longer period than those 6 3/4 years, that is the kind of outperformance that we've been able to see or more. However, there are periods where that's very difficult to achieve, and there are periods where that's actually quite easy to achieve. And certainly there was a period between about 2018 and about 2020 where it was particularly difficult. And indeed, as you can see by the numbers that I talked about relative to other actively managed investment trusts and the wider peer group, generally people have struggled to keep pace with the market cap index because that's been so concentrated in a small number of companies, now being termed the Magnificent Seven, that have really driven markets, and they're very concentrated in those stocks. We feel confident that in other scenarios where it's more broad in terms of what's driving markets, as we've actually seen a bit more in recent times, then that's something where we could see significant outperformance. And so over the very long term, we're still confident that we could achieve that kind of level of outperformance. But we sit here very pleased with significant outperformance since inception, and in particular over the last 3 years, given the market backdrop that we've seen, regardless of whether that's quite hit that very long-term target of 2% per annum.
Most people would have the impression that 2023 was a year which was dominated by a very small number of stocks, the concentration of the index, as you've alluded to. So your stock pickers must have picked some of them, otherwise they wouldn't have been able to produce this outperformance in the last 12 months. So what is your exposure to the Magnificent Seven or stocks of that sort, and where has the main contribution come from in terms of that outperformance that you had in the last 12 months?
So there's a few things to unpick in that. Firstly, you're right. We do have some exposure to the Magnificent Seven. In aggregate, we're slightly underweight the Magnificent Seven, and we've pretty much been underweight the Magnificent Seven that whole 7 years, albeit that it's not been a big underweight for most of that period. But within the Magnificent Seven, we've been overweight, in particular, Alphabet and Amazon, and we've been underweight Apple and Tesla. Indeed, we've had zero in Tesla for that entire period and close to zero in Apple on average. So we've been zero most of the time in Apple, but occasionally had a small position. But those have been the two stocks that we've been very underweight, which was particularly painful a few years ago when those two stocks were the ones really driving markets. But on a relative basis, the overweight Alphabet and Amazon and underweight Apple and Tesla has actually been helpful from a stock selection perspective in more recent times. But the important thing here is that it hasn't just been the Magnificent Seven that's been driving our returns. So I think over the calendar year 2023, more than 50% of the return from the MSCI All Country World Index, some 53% in fact, came from the Magnificent Seven. It was 34% of our return. So we were getting very strong stock selection from outside of the Magnificent Seven across multiple industries, across multiple geographies, exactly what we would expect. And I think the big difference in 2023 for us versus some of the prior years when a small number of companies were driving markets was that outside of those Magnificent Seven, actually fundamentals did seem to be driving share prices. So there were previous periods where it didn't really matter whether your companies were delivering strong earnings and beating expectations from an earnings perspective or not. All stocks were going up or down. Whereas in 2023, there was a lot more differentiation, and that was a lot more helpful for strong stock pickers as we've got in the Alliance Trust portfolio. So those are probably the key things that I'd bring out as to why 2023 was a bit different, despite the fact that it still had some narrow leadership of the index.
One of the interesting things you include in your presentation is how many of the 10 managers that you have hired to come up with their 20 best ideas actually did have the same position in some of those Magnificent Seven stocks. So, I mean, obviously the one that people will be interested in would be Nvidia. You have a position in that, obviously, through your stock pickers. Well, how many of them actually were jumping on the Nvidia bandwagon, if I can put it that way?
Yeah, so the weighting in Nvidia did change a bit over the course of the year. We generally had one or two stock pickers in it at a particular point in time. The stocks where we had multiple managers in there, in particular, were Visa, Alphabet, and Amazon, where, as at the end of December, for example, 5 of the stock pickers had Visa, 5 had Alphabet, and 5 had Amazon. Not the same 5 in all 3, but there were 5 of the stock pickers that were in each of those. Of the rest of our top 10 overweight positions, the majority of them were still owned by just one stock picker or 2 stock pickers. But those were the 3 stocks where we had a number of stock pickers investing in them.
So you have this roster of 10 stock pickers that you use. That changes from one year to the next, at the margin at least. I think there's sort of one change you might make in a year on average. And some of them are quite specialised, obviously. You recently took on a firm that specialises in Japanese equities, for example, and they presumably wouldn't be investing in Amazon and so on. But if you look down that list, I mean, the 2 kind of style things that come out are value and quality. But does it actually make any sense to talk about the style bias of this portfolio, given that you're trying to eliminate style bias?
Well, you're absolutely right that the individual stock pickers can have some quite strong styles amongst them. What we do is spend a lot of time thinking about which managers blend well together and what weightings we should have between those managers, such that overall it doesn't have a style bias. But absolutely, when you look at the individual managers, they do have a style bias. So some of them would be very strong, deep value managers. Some of them could have more of a quality bias. Some of them out and out long-term growth stock pickers. Most of them are in a global go anywhere portfolio, so they could invest in any country, developed or emerging. But we do have a couple that specialize a bit more. So GQG, for example, run 2 portfolios for us, and one of them is a specialist emerging market portfolio. And then As you alluded to, one of the more recent managers that came in July 2023 was Dalton. Now, Dalton are a Japanese specialist, and the background to that one was not a top-down call on Japan looking attractive, but as it happens, as a market, it probably does look pretty attractive, and as a currency, and so that's an added benefit. But our main reason for putting it in here was some of the structural changes that we've seen in the Japanese market that meant we could see reasons why a strong stock picker could produce significant outperformance or alpha in that market, particularly down the capitalization spectrum. It's kind of the mid-cap area rather than the large cap space. And so for those that have been paying attention to the Japanese market, there have been some reforms there with the Tokyo Stock Exchange, for example, putting pressure on companies to say why they've got a price to book value of less than 1, for example, and what they're doing to address that. And so that's leading to more shareholder friendly approaches from management, spending cash on balance sheet appropriately and the like. And that gives great opportunities for a stock picker like Dalton that's been investing in Japan for decades and thinking about companies that are shareholder friendly in that guise. So that's why they came into the portfolio in July 2023.
So obviously there's been a lot of interest this week in another of your managers, and that is a gentleman called Ben Whitmore at Jupiter, who is leaving Jupiter, or has announced he's leaving Jupiter to set up his own boutique investment firm. How would that impact what you do? I think you've got him under review now. What does that actually mean, and what kind of things were you thinking about when you're looking at that particular holding, which I guess makes up the majority of your UK equity holdings?
Well, the first thing to say is that Ben runs a global mandate for us, so it isn't specifically a UK mandate. He runs at Jupiter a lot of UK equity money, and he runs a bit less in global equity money. And one of the accounts that he runs is for Alliance Trust on a global best ideas, maximum of 20 stocks portfolio, like some of the others in here. Now, this is one of the big advantages of the multi-manager approach. Ben makes up 9% of the Alliance Trust portfolio at the end of December. We think he is a highly talented stock picker. He's, as you say, has announced that he'll be leaving Jupiter in a few months' time. We still think he's a high quality stock picker. We think he's highly motivated still to produce strong results, particularly as he'll be setting up a new organisation for himself. So no panic there in terms of us needing to get out of the portfolio immediately. So we've got a number of choices there, as we have in any situation like this in a multi-manager portfolio. We could follow Ben to his new organisation. We could stay with Jupiter and have an alternative portfolio manager. We could take the money and just spread it amongst the other 9 stock pickers that are in the portfolio. Or we could replace Ben with one or more other managers in the portfolio. And we're considering all of those options. But as I say, for now, we're very happy that Ben's running the portfolio exactly as he has done for the full 6 3/4 years that he's been in the Alliance Trust portfolio. So we will be making a formal decision on that in the next few months. And there'll be an announcement around that. But for now, no change in the way the portfolio is managed.
So I have to ask you a little bit about the UK equity market and how you're exposed to that. Obviously, there's been a lot of talk recently about both the rating of the UK market and also whether the government can do anything to boost the UK equity market. Do you have any views on that? Obviously, you're pursuing your mandate to the best of your ability, and that'll take you wherever it leads you. But do you have any observations, shall we say, on the UK equity market and whether you're likely to have more or less exposure in there, driven by your stock picking teams?
The summary is that at the moment, we are slightly overweight the UK. Now, this is very much a global portfolio. It looks a bit more similar to the MSCI All Country World Index from a top-down country perspective, and the UK is only about 5% of the MSCI All Country World Index. We're overweight the UK. We're more like 8 or 9% in the UK. That said, a number of the stocks that we own in the UK are large global multinationals, so that it's not necessarily a massive overweight exposure to UK domestic type companies per se. I don't think that that's going to change hugely. I mean, it's fair to say that a number of the stock pickers have found the UK looking reasonably attractive following very strong run from the US in particular, UK being a laggard in terms of performance. And so a number of companies, particularly some of the global companies that are not impacted by UK domestic issues, being rated more like UK companies than global companies, and hence looking quite attractive on a valuation basis. And so we have got an overweight, and that may well continue for some time. But we're not looking at structurally changing anything. We will continue with the MSCI All Country World Index as a benchmark.
Let's just then take another step back and think about this problem of concentration in global equity markets. In your view, that's contributed to the difficulty that active managers have faced, including yourself, over the last few years. And that's obviously been very good for passive funds. They've benefited from that because whatever their valuations may be of the underlying stocks, they own them in the market proportion. So it's gone on for a long time. What do you think might actually change that? And do you actually see any signs of a catalyst that will lead to a period when active managers might once again perform better than their passive equivalents on average?
Well, it's a good question as to when that changes. And to be honest, it's a very difficult one to answer. But one interesting bit of analysis we sometimes show is what the makeup of the index has been at the end of every decade. And what you'll see is that there's many times where it's been quite concentrated in a small number of companies, and quite rarely does it have the same makeup a decade later. And these things tend to have cycles in them whereby some of those stocks that have been the largest stocks in the index a decade earlier continue to be there, but a number of them tend to go away. And it's quite difficult to predict which ones those are in advance, 10 years in advance as to which ones those are going to be. But that's what the best stock pickers are doing all the time. They're thinking about which ones have had the market get overly optimistic about their prospects in the valuation of the stock and be willing to take a zero position in those, but hold on to the ones that really are going to be the winners for the next decade. And we've certainly got some significant differences to the benchmark. We're running a highly active portfolio here relative to the overall benchmark. So we're confident that that will happen. Interestingly, in 2023, active managers have generally had a better time relative to passive, despite the concentration. So we think that that can continue over the course of the next few years. We had a very strong year, as we've talked about, in 2023, and actually over the last 3 years. And that's really been this fact that fundamentals have been driving markets. So it's an interesting question as to how much of the underperformance active managers in aggregate have had to passive has just been the concentration issue, and how much of it has been the fact that macro events have been driving markets for some of that period rather than the underlying fundamentals of the companies, which is ultimately what long-term stock pickers are focusing on. And if that starts to be coming through over the next few years, you could well see a very different story where active managers in general do pretty well relative to passive. Of course, if you also happen to get the largest companies in the index having a tough time, then that could precipitate a very significant level of outperformance from active stock pickers. But we sit here very confident looking at our portfolio and the latent value in that, and the conversations we have with the stock pickers about some of the companies we're owning and how they're continuing to deliver exactly what's expected from a fundamental perspective. In other words, beating earnings expectations quarter on quarter, and it hasn't yet come through in share price appreciation. So we sit there very confident about that.
Now, I mentioned earlier on that you've always had a strong retail private investor following. A lot of investment trusts and a lot of open-ended funds have seen outflows of assets in the last few years, particularly from larger investors. But what's your approach to the private investor? Are they still the mainstay of your share register? And what are you doing to make sure that they stick with you?
Yes, they are, and they will continue to be a very important part of our share register. And so we're spending a lot of time and effort on marketing and getting the message out there to that group of investors, and that seems to be working well. For example, our discount to NAV has stayed very stable, and the amount that the board is doing in share buybacks has reduced significantly, whereas you've seen other trusts in the sector have not only seen their discount widen, but even to keep it at that wider discount, they've had to do a lot more proportionately in buybacks than we have. So it certainly seems as though the message is getting out there. The trust seems to be very popular amongst those retail investors, and hopefully that will continue as we continue to deliver strong performance for them.
One of the issues we talked about when I spoke to you a couple of years ago was about the gearing that you use. Obviously, one of the advantages of investment trusts is you can use gearing. You said, I think, that while you try to maintain a beta of around 1, in other words, a market sensitivity around 1, so that most of the return can come from stock selection, you did say that your view of where we were in the cycle and the macro factors could influence the degree of gearing that you use within the trust. And at the moment, it's a relatively low figure. Am I right about that? And if so, what's the thinking behind that?
You're absolutely right on all of those points. So strategically, we have an assumption that will be about 10% gross gearing on the portfolio on average. And then what we try and do is not take big positions relative to that, such that WTW's view on markets starts swamping the performance of Alliance Trust. Okay, we want stock selection to drive everything. That said, we will influence that gearing level, reflecting our view on how cautious or how excited we are about the market as a whole. So, for example, whilst 10% is our strategic level of gross gearing, we tend to be somewhere between 7 and 13% geared on a gross basis, depending on our view on markets. At the moment, we're at the lower end of that. So nearer the 7% gross gearing, more like 4% net gearing. And that's because we're relatively cautious about markets. There's a lot of uncertainty out there. Obviously, rates have risen and the market is assuming that rates are going to fall quite quickly from here. And I think there's some uncertainty as to whether they'll fall quite as quickly as the market is assuming. We have had a long period of equities doing very, very well. And so we just sit there a little bit cautious from a top-down perspective. So more like the 7% gross gearing than the 10% gearing. On the flip side, when we look at the portfolio and we talk to the stock pickers about the companies that we've got in our portfolio, we're very excited about the latent value in that. So very excited about our stock selection potential and the outperformance of the market that we might see, but some caution on overall equity prices after a period of doing incredibly well generally as a market. And so that's why we're at that 7% gross gearing.
My final question about the mechanics or the attributes of the trust in its portfolio at the moment, I guess I have to mention just costs. Obviously, it's a very competitive business these days, and there's a lot of talk about the impact of cost disclosure and so on the way that investors regard investment trusts in particular. You obviously have a multi-manager approach. How are you affected by the cost disclosure issue, and what do you say is the best figure to use for what the cost of owning your trust is, what you're paying for the privilege of having your money invested by Willis Towers Watson on behalf of Alliance Trust?
Well, the first thing to say is that our fee structure's nicely transparent here. We don't have embedded performance fees or anything like that. And so you can look at the OCR, the ongoing cost ratio of the trust, and understand exactly what it is that's being paid for in that trust, because that's including all of the costs of running it as a trust, having the independent board members, all the costs of administration, the cost of the underlying stock pickers, and the costs of WTW, all included in that OCR figure. And that's just over 0.6% for the trust. That OCR number actually looks very, very attractive relative to any other multi-manager approaches that are out there, but actually looks pretty good relative to most single manager approaches. And as I said earlier, the issue with many multi-manager approaches is that they have got this double layer of fees and so can end up looking quite expensive. That doesn't come out in the Alliance Trust numbers because of us being able to use our scale at Willis Towers Watson.
Okay, so that, I think, brings us to the end of our interesting conversation. Craig, thank you very much for your time. I perhaps just finish with, you obviously sounded very positive on this call. You've had a good year, and that's naturally to be celebrated. But you have some caution about the outlook for global equities. I think, would that be a fair summary from here? Some
caution. I mean, we're not sitting here being very negative about what equity markets are going to do from here. I just think it's natural after a long period of strong performance to have some caution from a top-down perspective. But yeah, we're excited about the portfolio, not just based on 2023. Let's be clear, 1 year performance is nice, but much more important to look at the longer term. We're now upper quartile over 1, 3 and 5 years. And we've had significant outperformance of the index over 1, 3, 5 and since inception. So all positive to see those long-term numbers, but just as importantly, when we look at the portfolio from a bottom-up perspective, that excites us as well for the potential over the next few years as well.
So that was Craig Baker, the Global Chief Investment Officer of Willis Towers Watson and Chairman of the Alliance Trust Investment Committee, reporting on a good year in 2023 and some interesting prospects for the future. So we had the budget this week, and we're coming up towards the end of the financial year, which also means the end of the ISA season, among other things. With that in mind, it was a good moment to catch up with James Carthew, who is the head of research at QuotedData, the trust research firm. So my first question to you, James, will be, what do you make of the market so far this year and how the investment trust sector has been moving, if it's been moving at all?
Well, we started off with kind of great promise, really, because on the back of what was perceived as the peak of rates in October, it all seemed to be a bit more rosy than last year. And then we had some disappointing inflation numbers in the UK for December and then for the US. And bond yields have started to climb again, and anything that's sort of priced off bond yields has gone down again. And it's all been a bit of a mixed picture, really, and not quite as good as we hoped. But I'm hoping this is just sort of a delay before we get going again. So we still might have a good 2024, but these past couple of months have been a bit more disappointing than I'd hoped.
Yeah, so the Investment Trust Index is up 1% this week, but it's only up, I think, around 2% to where it was at the start of last year. So overall, it's been a fairly flattish period, though we've had quite a lot of excitement along the way. Was there anything in the budget? I mean, I noticed in the budget, for example, that there was no mention of investment trusts cost disclosure. You probably might think that's a little niche for the Chancellor to get excited about, but he was talking a lot about stimulating the UK economy and the UK equity market. Anything strike you out of that? Was that a disappointment to you as well?
The failure to tackle the cost disclosure thing is becoming very frustrating. I mean, they made lots of encouraging noises about this earlier in the year, and I am aware, I think by the time this comes out, there's a letter going to the Times to highlight this issue again, and the urgency that which needs to be tackled, but we'll see. The thing that people sort of seized on, I suppose, was the Brit ISA, the British ISA, £5,000 extra to put into UK investments. It is extra, though. I think that's the problem. I don't know how many people are going to have enough money to take this up in full, and so whether that's going to make a big difference or not, I'm sort of dubious. Nevertheless, it is a step in the right direction. It's all part of this general theme of we must do something to tackle the low performance of the UK market relative to everywhere else. So the ambition is there. Whether that's the magic bullet or not, I think the jury's definitely out on that.
Yes, I mean, they're going to have a consultation about how this UK ISA is constructed, what it will consist of, and it will take time. Obviously, it has to be dealt with in Parliament. And as you say, most people don't spend their existing entitlement anyway, 20,000 a year, so an extra 5,000. Though they could, of course, use it as an alternative as part of their overall ISA allocation these days, because you can mix and match them now, can't you, under the new flexibility. And of course, the question of how would you define what goes into a UK? What is a UK company?
Exactly.
It's not a UK listed company because a lot of them are global rather than UK based. So there's lots of issues there to be resolved, I think, before we can get very excited about that. You're absolutely right. Well, let's turn to the investment trust sector and a little bit of what's been happening this week in terms of news. We are in the results season. We're beginning to see, particularly for some of the larger equity trusts, their latest annual and interim results for the period to the end of December last year, so calendar year in many cases. This week we heard some of the big global equity trusts. We heard from both Alliance Trust and Foreign and Colonial Investment Trust, two of the granddaddies of the sector, but very different performances. What did you make of those two?
Yeah, it was quite striking, the difference in the returns, actually. Alliance Trust beat the F&C fund by about 10 percentage points last year. So F&C underperformed and Alliance Trust outperformed. And it was a very difficult market last year for active fund managers because it was all driven by this Magnificent Seven AI mega cap type stocks. And if you didn't have a full weighting in those, it was a really tough job to try and beat the index. So the fact that Alliance Trust managed to do it and do it in spades, I think is really quite commendable. And that all comes down to its approach of finding really good stock pickers and then letting them put their best ideas into the portfolio, while simultaneously trying to make sure that the balance of the portfolio isn't skewed to value or growth or large cap or small cap or any other sort of style factor. So that combination of things did allow it to outperform, and that's a really big tick in its box. I've been looking at the numbers this morning, actually. If you go back a decade, Alliance Trust was probably in trouble. There was lots of question marks over its future. It had an activist investor and all that sort of thing. And they rejigged the whole investment approach in 2017 under Willis Towers Watson and adopting this best ideas kind of idea. And that's now working so well that it has now overhauled F&C in terms of the 10-year numbers. And I think it will just carry on going. I do like this one.
You're right, their performance differential between what they've achieved and what F&C have achieved is quite striking, of fully 10%. And a 21.6% NAV total return over the course of the year is obviously pretty impressive, well ahead of its benchmark.
Yeah, the All Country World Index, I think, was 15.3. F&C was slightly hampered because it's got an allocation to private equity, which is about 11-12% of the fund. And that actually lost the money last year. So an environment where the equities are going up and the private equity is not contributing anything, that was probably quite a big drag on its returns. But even so, its equity stock selection wasn't as good as Alliance Trust by quite a long way.
And of course, that was one of their strategic moves, was to actually have some exposure to private companies, which was in common with a lot of people 2 or 3 years ago, and obviously exemplified by Scottish Mortgage and others. We can also have a look at the results of RIT Capital, ticker RCP, which is obviously a slightly different vehicle, but which has always had a significant exposure to private equity and a number of specialist funds as well. Their figures were also very disappointing. They just produced an NAV total return of 3.2%. Well, that was for the year to end of December. Well, that was positive, but it was well behind their benchmark, which actually produced an even higher return of 18.4%. So they were well behind the benchmark. And so far, the shares remain on a discount of 25%. We've heard the sad news that Jacob Rothschild, who started RIT, has passed away. But they don't seem to be any nearer to regaining the confidence of the market at the moment. Would you agree with that?
That is true. I'm hoping that this is about to change. I'll tell you why. Because in those results, they said that a large part of the problem was that they've got probably too much in private markets. That's for the one thing. So they've admitted that. And the chairman says they want to reduce that exposure over time. They want to do it organically. They want to run that portfolio down relative to the others. So that's been part of the problem. But the reason why that part of the portfolio didn't perform very well last year was when the markets were falling in the back end of 2022, those numbers weren't captured in the NAVs of those private funds at the end of December 22. They came in to the actual numbers in January, February 23. So you've got this sort of lag effect where the underperformance of 2022 showed up in 2023. So that's one reason why it underperformed. But if you fast forward to today, we've had much stronger markets since middle of October when it looked like rates have peaked and growth stocks and things have picked up a bit. All of that is not reflected in RIT's returns for 2023, but should be picked up by the time we get to the NAV for the end of March 24. So hopefully we'll start to see the tick up soon. Fingers crossed.
Yeah. And also, of course, there's been a change of senior management at the trust for a mixture of personal health reasons, I believe, family reasons. The two most important principals in the management of the trust are no longer full-time there. And there's a new CIO come in. It'll be interesting to see how they perform. And the discount, as I said, is still very wide. So you might be right that the performance will improve as those numbers come through. But they still need to go some, I think, to re-establish themselves as they were the kind of go-to choice for many investors looking for some kind of multi-asset solution, were they not?
Yeah, they definitely were. And I still have faith in it. I mean, I've got a shareholding in this, and for the long term, I still have faith that this will do okay, but it has gone through a difficult period. And as I say, hopefully we are just about to come out the other side of it.
Indeed, we all hope that. So, as I say, a lot of results, all of which you can see summarised in our latest weekly email. A lot of larger trusts there. We just picked out some of the more egregious numbers. Interestingly, there is quite a lot of dispersion across the universe. We heard from Premier Miton Global Renewables, for example, which produced a negative NAV total return. One or two others in the renewables sector have been doing better. We might talk about the renewables sector first then when we turn to news there. We haven't had a favourable bond yield backcloth so far this year, and obviously there's hope that that will happen. What are your general thoughts on the sector, first of all, and then we'll look at a couple of individual names?
It feels to me as though Well, there's been a sort of buyer strike going on, and this is all partly into this cost disclosure issue that we mentioned. And some of these prices are becoming really quite volatile. So just personally, in the beginning of February, I picked up some shares in SDCL Energy Efficiency. They were trading on a 12% yield and a 40% plus discount, which was just bonkers. And lo and behold, they're now up like 25% or something from there. So that happened, and it's all driven by buying and selling because it's not the underlying stuff. There's no new news on it. And then at the same time, Next Energy Solar, share price kind of collapsed in February for no good reason that I can fathom. And that's now on like an 11% yield. We just published a note on that today, actually. And I just think that there are some real bargains in this sector. You just have to go, looking for them. And there are obviously individual funds that are problematic and struggling. But by and large, I think most of these things are just too cheap now.
Right, but the challenge for a number of the trusts in the renewables and also in the infrastructure sector more generally is how to deal with the discounts that they're trading at. Obviously, if there are no buyers, that helps to explain why they go so wide. But is it not also the case that there's a limit to what some of these renewable energy and infrastructure trusts can do in order to eliminate the discount? They can do share buybacks, they can repay debt, they can try and sell some assets and so on. But those steps in themselves may not be enough to get them back to the happy land where they were able to issue new equity at premium. And that's where some of them need to be if they're going to deliver the returns they've promised.
Yeah, it is true. They've been trying very hard to do what they can to tackle discounts, and a lot of them have done share buybacks. Bluefield Solar just launched one recently, a 20 million quid one, and it's paying for that out of the surplus cash that it's generating in the portfolio. So actually, it's this year, I think it's saying the dividend's going to be covered 2 times by cash flow. So what it isn't paying out in dividends, it can use to fund share buybacks, and also, if it got anything left over, it could do some new investments. But actually, it's one of the funds that's thinking outside the box in terms of what you can do there. And it's done this tie-up with GLIL Infrastructure, which is like a group of local authority pension funds. And they are going to help fund its pipeline of new investments and provide some cash to the fund by buying part of the portfolio of them. So there are things that you can do to free up cash and help recycle money. Next Energy, that I mentioned just a second ago, they're similarly doing something like that. They've put up for sale 5 of their subsidy-free solar farms, and one of them sold in November, and it was the one that they hadn't actually built yet, so it was a sort of like a construction-ready project. But the other 4, they've said in their results recently, they are on track to sell these. They're going to be sold in 2 parcels of 2 funds, and they could fetch decent money, which can be used to pay down the credit facility and fund buybacks and things like that. So I am optimistic again that things will shift there. But there needs to be a much bigger picture shift too. Retail investors, I think some of them, when you see something that's trading on an 8, 9, 10% yield, you start to feel nervous about, well, why? Is there something I haven't spotted here? But really it does come back down to this cost disclosure problem and the fact that the institutional investors just aren't buying these things. What we could see, and I wouldn't rule it out, is a bid for one of these things because they are cheap relative to what's going on in the market. To give you some example of that, Greencoat, which is all part of Schroders now, they bought a portfolio of solar farms in January, and they paid a price of about 1.35, 1.36 million per megawatt for these solar farms. And I worked out the other day that the Next Energy portfolio is trading on about 1.04 based on the current share price. That gives you an idea of the scale of the undervaluation. So if people like Greencoat are prepared to go out and spend 700 million quid on these things, it's not beyond the bounds possibility that somebody will just come along and bid for one of these funds if they like the assets.
Sure, it's a kind of risky way to try and make money, if you like, to bet on somebody coming along and bailing you out, particularly when you don't know exactly how realistic the NAVs are in the current market.
But I wouldn't fixate on the NAVs, I'd fixate on the yields. If you think, I like the look of this yield, the yields are sustainable, I think, for the basic renewable funds. We're not talking about battery ones now.
Okay, so we ought to have just mentioned before passing out of the renewable energy sector the latest news from Asian Energy Impact Trust, which is one of the trusts whose shares have been suspended. This week it came back from its share suspension, but it wasn't a very happy day for them, was it?
No, back with the bump, I suppose. Yeah, I think given the uncertainty around the future of that fund and the enormous hole that its investment in India has left it with, it's not a great surprise that the share price moved to a big, big discount. There's been lots of different votes in sort of slightly confusing way, the board trying to feel their way forward here. There seems to be a sense that shareholders want it to carry on going, but it can't really do that unless it can raise more money. It can't really raise that money at a discount. I kind of struggle to see how this is going to work unless there's some mechanism by which they can fold what's left into another fund.
Right, so the shares came back from suspension and they immediately fell even further. The most recent NAV we had, which was back in June last year, was around 50 cents, and the shares are now trading well below that level.
Yeah, they are.
Even so it's got a very uncertain future. We should remind listeners that this trust used to be called Thomas Lloyd Energy Impact, and they had this problematic solar project in India where the board decided that it was actually, while there was a negative net present value on the project, it would cost them more money to stop it than it would be to go ahead. That's obviously not a place where you really wish to be if you can avoid it. So let's talk about some other news. There have been a couple of other of our, what I would call problem children, have also put out some more news this week. One of those is DGI9, the Digital Infrastructure Trust. Here there was actually more positive news, I think, for them this week.
Yep, finally. Again, I bought a few of these. I just thought this is getting silly now. Everybody hates this with a passion, so it looks oversold. And I think I'm just about making some money now. So it's been forced to sell its prize asset, which is its data center business called Verne Global, the biggest part of which is in Iceland. And there was a hiccup in that the Icelandic authorities said they wanted to look at the deal before they'd approve it. And that sort of just delayed everything and called into question about what was going to happen to that business, because the reason they need to sell it is because it's desperate for cash funding and they need a buyer with deeper pockets. And this week we actually finally got sign-off, firstly from the lenders and then secondly from the Icelandic authorities. So it does look like that's going to go through now, and that will free up some cash, which will let them pay down their debt facility. And then we can look to the next stage in the process, which is to sell off more of the portfolio and start handing back some cash. It's going to be a long, drawn-out process. They've got one asset, the towers that broadcast TV in the UK, called Arqiva. That one they think is going to take a little longer to sell. And the way that the Verne Global deal has been structured is got like an earn-out period, which doesn't really crystallise until 2027. So we are talking about years before you get back all of the money on this. But I'm hoping that with the debt paid down, the whole thing's been considerably de-risked, and then we might get some action in terms of money coming back end of this year, beginning of next. And it's still trading on a big, big discount to asset value.
Indeed, the shares, I mean, they peaked at around 115p 18 months ago, and they're now, at 23p, somewhere around that. So it's a huge discount, and the stated NAV, of course, is what it is, but it's considerably higher, so the discount is huge. But it's disappearing, shall we say.
Yeah.
We also heard, again, more from the ongoing saga at Hipgnosis Songs, SONG, where we finally got another valuation for the portfolio from another party of valuers. But that isn't entirely clear where that leaves this one going. We know that the board has got to come up with some proposals quite shortly. They had a 6-month grace period to decide what to do with this particular vehicle, the shareholders having said they thought there was a good business in there somewhere. What's your reading of where we've got to in terms of the sort of game that's going on between the investment management firm, Hipgnosis Songs Management, and the board, which is trying to sort things out for the shareholders?
Well, this new valuation is interesting because it was an awful long way below the old one. They do it all in dollars, so it's easy to think about in pence because that's where the share price is in pence. The old NAV valuation was about £1.37 and the new one's about 92p. And the share price plunged on the back of that. But I think it's more likely that the share price fell because a lower valuation for the Song portfolio obviously drags down the NAV. It means that it pushes up the gearing because the debt's now a bigger proportion of the whole, and their gearing number is now too big. So the board said, well, that's it, no more dividends now. We need all of that cash to pay the debt down. And I think that's probably what has upset shareholders and driven that share price down again. But it does now put a valuation on the portfolio that seems a lot more reasonable. And if you couple that with the fact that shareholders approved this idea that if somebody bids for the fund or for the portfolio or bids the portfolio and gets all the way through the process and then loses out to a bid from the manager because the manager's got this right to match a bid from another third party, then the company will cover their costs. It's all a bit complicated, but basically it means that somebody can make a run at bidding for the fund and not have to worry about having a sort of sunk cost of their legal expenses if they get cut out at the last minute. I think we are getting closer to a scenario where you might get sensible bidders for the portfolio. I think it will be for the portfolio and not for the company, because one of the things that the manager has left us with is the possibility that the company will be subject to a lawsuit for things that he did before the fund was launched. And why he's refusing to indemnify the fund, I just cannot understand. That's been part of the fight recently, that they asked him to indemnify the fund against the costs of this, and he refused to. So there's lots of toing and froing. Back of my mind, I'm hoping that the portfolio is still being run properly, that there's still being the same attention to maximising the revenue that there was going on before, because it does need this kind of constant effort to market songs to films, film rights and adverts and that sort of thing to keep the money flowing in. And I hope that the manager's not losing interest in doing that. So yeah, the best course of action will be that a bidder comes along and we get something that the portfolio sold and some money returned to shareholders. But the board's kind of at mercy of third parties on that, and we'll just have to wait and see what happens.
Yeah, we do. I mean, I think it seems to be the outcome will be either that Hipgnosis Songs management does put in a bid and is allowed to continue managing the portfolio. It doesn't appear to be the board's number one choice, given all the history of their difficult relationship, or that either somebody else can come in and manage it, or that the thing can be in due course be wound up. But I think they do want to keep it going if they can. So yeah, that's all still to play for. The shares did fall quite sharply on the valuation, but they have picked up a tiny bit since then. They're now at around 61p, I think, which can be compared to that new valuation that you mentioned earlier of 92. Elsewhere on the news, I thought I'd just ask you one final question, James. I don't know if you've been looking at the commercial property sector, where we have these two bids effectively have come in for Abrdn property income. We had one from Custodian REIT, which the market didn't seem to like very much. And then we had a rival offer from Urban Logistics REIT, ticker SHED. So this week, I think we had a circular from Custodian saying why they thought they were still the best people to take on the assets of Abrdn property income. It's good to have a bit of competition for once in these circumstances, I would say, from a shareholder's point of view. Do you have any clue as to where this one might be going?
It's exciting, isn't it? Yeah. No, I don't know which way it's going to go. It sort of depends on your viewpoint, really. So the Abrdn property income portfolio is more similar to Custodian REITs than it is to Urban Logistics. So you'd think it would be a better fit with Custodian REIT. There's a parallel here, though, between what's going on with Tritax Big Box and UK Commercial Property. So Tritax Big Box has made a bid for UK Commercial Property, even though UK Commercial Property it does have some exposure to logistics, but it's not the whole portfolio. So you think there's not a natural fit there. So it's a bit like akin to Urban Logistics and an API. But the clever thing there is you take in the UK Commercial Property portfolio into Tritax Big Box and then sell off the bits that aren't logistics. That frees up cash then for you to fund more development in the logistics portfolio. And so it feels a bit like then you've achieved a kind of rights issue for Tritax Big Box that you wouldn't have been able to do otherwise. And I think it's the same thing with Urban Logistics and API, that if you can take that API portfolio in, sell off the bits that aren't logistics, and then use the cash to fund whatever you want to do, it gives you just this ability to raise more money that you wouldn't have had otherwise. So I think that's the angle. That's the angle for Shed. For Custodian REIT, well, all of these things, that they are share offers. And so the minute you do something like this, you get this sort of merger arbitrage thing going on where people come in and they sell the bidder and buy the buyer, and and that's probably the thing that made the Custodian REIT share price fall. So either way round, whether they're successful or not, when the bid's concluded, that sort of indigestion might go away anyway, and you might get a bit of re-rating.
Right, but the point about that being because these are sort of all-share mergers that are being proposed, effectively the value to the shareholders in Abrdn Property Income Trust depends quite significantly on what happens to the share price of those who are making the offer, effectively. So far, I mean, the shares are up from the all-time low in August, I think, of 44p last year. They're up to around 55p, but it's nothing like the kind of uplift that you might have expected if you'd got a cash bid coming in from somebody at a reasonable premium to the share price.
Yeah, I think either way, once the bid's done, the combined vehicles should get re-rated, in my view.
So that's one to watch out for. We'll find the outcome out of that one in due course. So anything else on your mind at this point, James? What are you going to be saying? You'll be speaking at the Master Investor Show. Well, you will have spoken by the time this podcast goes out, but what's your basic argument you're going to be putting forward there?
So I was just going to look at those big discounts on the renewables and the infrastructure funds, actually, because, as I said, I do think the yield opportunity there is too big to pass up. And you've got a complete range of things. Within those two sectors, you've got sort of some really ultra-conservative things on attractive yields up to slightly more speculative things on really very attractive yields. And so if you're looking for income, I think it's quite a good hunting ground. So that's going to be the main topic of the chat. Although I haven't got that long to talk, so I'll squeeze as much in as I can and then probably end up talking mostly to people on the stand.
Well, there's that, of course, a chance to mingle with some of the several thousand investors who will be there at the Master Investor Show, where I also will have been speaking. So thank you, James, for your comments this week. Look forward to the next time. And let's hope the next time when it does come round, we've got a slightly more positive backcloth than we've had so far this year. That was James Carthew, the head of research at QuotedData, the investment trust research firm.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.